Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
On today's Bloomberg Intelligence Show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies in 130 industries our analysts cover worldwide.
Today, we'll look at why Tesla's staff are said to be bracing for potential job cuts.
Plus, we'll discuss why war in the Middle East is hurting McDonald's sales.
But first, we dive into Walt Disney. Earlier in the week, the company reported better than expected earnings for its fiscal first quarter and issued an upbeat profit outlook for the year.
For more on all of this, we are joined by Geetha Ranganathan, Bloomberg Intelligence Analyst on U.S. media, and we asked her why there is reason for optimism at the company.
Disney is definitely back with a bang. One of the big pain points with Disney has really been the lack of streaming profitability, but now there seems to be a clear path to the streaming business kind of getting to that profitability metric. So we saw the losses come in way below expectations. It was 65% below what people were projecting. They're still kind of guiding to hitting profitability by the September quarter, but most people, I think, on the street expect it to happen much, much sooner. And then Hugh Johnston, who's the new CFO, and this was his first call with Disney, basically said that look to or expect double-digit operating margins in the streaming business. And I think that was something that was really, really powerful because we know that, the number that we're all chasing is that 20% operating margin where, Netflix has been. I think the one area that we kind of still need clarity is how all of the streaming bundles are going to work. So it's really good to see them kind of be proactive and go out with their own solution. So they have that sports super app that's coming out a little bit later this year in conjunction with Fox and Warner Brothers. They have their own ESPN Plus standalone app. Again, a little bit of, we're not really sure whether those are necessarily going to cannibalize each other. I don't think so. I think really Disney, what they're trying to do here is kind of create this super bundle because they know that, content bundling works and everybody's kind of looking, aggregation is the holy grail. And I think Disney wants to be at the forefront of it. But definitely we need a little bit more kind of clarity, at least around like what the financial value creation is going to be.
How about the theme park business? That seems to continue to be a really solid business for them. And I know they announced several months ago that they're really stepping up their investment in their theme parks and their cruises and all that kind of stuff. How did that business do?
Very, very well. So again, operating income was for the quarter was well above $3 billion. That was again above what the street was expecting. And really what we're seeing is a lot of momentum at the international parks. So they've opened so many new attractions in their overseas properties. You have a new Frozen Land in Hong Kong. You have the new Zootopia attraction in Shanghai. And both of those are doing really, really well for the company. And that has really enabled them to implement all of these price increases. So international parks really kind of doing extremely well. Domestically, there's a little bit of pressure from wage inflation. There's a little bit of pressure from, tough comps from like the Walt Disney World 50th anniversary celebration. But again, just transient. Parks are really set up very, very well. And you mentioned the $60 billion investment. Now, 70% of that CapEx is going to be towards new attractions. So this is really going to be a major, major profit driver for them going forward.
Geetha, there was a journal article that I just felt like helped someone like me who's not seeped in Disney like you guys understand how they're just seeping in to all the Americana that's out there. They said Taylor Swift, football, and Fortnite. That like anywhere that you will want to be or listen to or watch, Disney will be there. What did you make of the Fortnite investment?
Super smart move by them, right? It's so strategic, it's so smart, and it's still a kind of not a huge investment. 1.5 billion gives them some stake, gives them some skin in the game, and there's a lot of upside, not too much downside. So I think a really good way for them. And remember, Alex, they've had this kind of really checkered past when it comes to video games. It's not that they haven't been there. They were in the publishing business, didn't really work out for them. They exited that business in 2016, started licensing out a lot of their content, but licensing, you're still kind of this passive participant. participant. They really need to be there. They need to be an active participant in the video gaming industry. There's so much overlap between all of the audiences that go to the Disney parks and the people who are gaming, right? It's all these youngsters, and they really want to be there. And this is a great way for them to do it.
What are they saying about their theatrical business?
The content, the studio has not really been the blockbuster that it was. We've had a whole string of misfires over the past few months. But I think what Bob Iger was saying is they are in the process of rebuilding. Their whole content pipeline is refilling. They're having this really smart move here with this new Taylor Swift movie coming out on March 15th. And then they spoke about, having this new Moana movie. This was originally going to be a series on Disney Plus. It's now going to be a full-blown theatrical release. And again, we're prepping for 2026, really, which is going to be the biggest year for the box office ever since the pandemic. And a lot of that will be Disney kind of driving the slate, right? You have the whole Star Wars coming back with Mandalorian and Grogu. You have a whole set of Marvel releases. So it's going to be really interesting as we kind of build to that. So again, nothing really major in 2024, maybe other than, kind of the Deadpool movie. But we're kind of building towards a much stronger slate
I'm sorry.
in 25, 26.
Nothing big coming except for the Deadpool. Excuse me. I've been waiting for this movie for years. Deadpool 3?
You're a big fan of the franchise.
Definitely not my audience that I'm talking to right now. This is the third one. You're having Wolverine make a little cameo. Whatever. Anyway, it's going to be awesome. Paul, what do you make of how fast Disney was able to move?
Well, a lot of people tell you they didn't move fast enough, but I think
Bob Iger came in. I mean,
yeah, but the stock's been kind of dead money for a while, and Geetha well knows here. It's just a question of when can we get a sense of when those streaming losses are going to be in the rearview mirror. And Geetha, Bob Iger surprised us, I guess a year or so ago when he said some of these assets might be for sale, like the ABC network, some of the cable networks. Any update on that?
Yes, we did have him kind of say everything's up for sale, and then he kind of walked back all of that. It's kind of starting to make sense because they're obviously taking all that content, they're putting it now on the Super app. So it makes sense for them to still kind of hold on to their linear TV assets because they still do have very valuable sports rights on there. So I think they're kind of aiming for this bigger, kind of grander strategy. I don't necessarily think that they're looking to sell any of their linear TV networks right now.
Our thanks to Geetha Ranganathan, Bloomberg Intelligence Analyst on U.S. Media.
We turn now to the financial services sector. This week, UBS reported a fourth quarter net loss, citing higher expenses. The bank also announced it will buy back up to $1 billion in shares this year, and this comes as UBS seeks to keep investors focused on the upside of its complex integration of Credit Suisse.
For more on this, we were joined by Alison Williams, Bloomberg Intelligence Senior Analyst, Global Banks and Asset Managers. I asked her what her key takeaways were from this week's earnings.
Investors got as much as they could. They may have wanted a bit more. The one negative thing for the outlook is that 2024 estimates are likely going to come down a little bit because, the returns are going to be lower. But that's because I think UBS is trying to be aggressive in, pulling forward those costs. So they did upsize the costs on a gross basis, but they're going to invest those so not falling to the bottom line. So perhaps some disappointment there. They did reiterate their sort of 3-year target. They gave a longer term target that was in line with the high end before Credit Suisse. So I think those were all positive. The buybacks also a little bit better than expected. The big positive news was 27% increase in dividend. Also, fourth quarter, not so much great things going on there. So the miss was on costs. Their adjusted costs fell. Their integration costs or the restructuring costs were much bigger than expected. The wealth flows moderated a little bit, and the investment bank lost money.
Alison, what is the new UBS here post Credit Suisse? And full disclosure, I'm a client of UBS. Used to work at Credit Suisse, so I'm all over the Swiss stuff here. But where does UBS want to be now that they've acquired Credit Suisse? What are their ambitions vis-a-vis a global financial institution?
So I don't think that the big picture strategy has changed much for them, right? So their focus is on wealth. They're the premier global wealth manager. They added some assets. They added some relationships with Credit Suisse. In the investment bank, again, they're still focused on equities. So even though profit disappointed, revenue came in about in line. So that's a positive thing on the equities trading side of things. They did add, some incremental ads. There were some numbers around the traders. The Bloomberg News reported. We obviously look at the top line of revenue. they kept the M&A and the research areas were the areas that they added to, and those areas did pretty well in the quarter.
So what else do you need to hear to get more confidence in all of this? We need just like a kind of hold and wait for 2 more years, basically?
I think it is like a show me, right? So I think it's going to be a step by step. So Armati, as you know, said that, they might sacrifice a little bit of revenue because they are focused on profitability. They're focused on doing things right. So again, like those are the types of things that you have to have confidence. He has done a big turnaround at UBS before, but I think that it is the kind of thing where it's like quarter by quarter, investors have to start to see, some support for these estimates. Another target they put out was $100 billion per year for the next 2 years in net new wealth assets. So I think that's a pretty good target. But again, we saw some slowing in the fourth quarter. Some of that was mandates leaving with Credit Suisse relationship managers. Still pretty stable, but I think investors will want to see, more. So, over the next few quarters, UBS delivering on its plans.
So, Alison, you cover everything, all the global big investment banks, commercial banks here. Is the global bank, is that just left to the Morgan Stanleys, the Goldman Sachs, or whatever? It doesn't seem like anybody in Asia, anybody in Europe can compete against the JP Morgans of the world.
So, Paul, it's really been over the last decade, ever since you left the business, but
it was Paul. It was all
the
Paul.
last decade, the U.S. banks just really making those market share gains. Credit Suisse is sort of the latest to provide some gains to those U.S. players, if you will. Keep in mind that sale from UBS follows them exiting prime brokerage. Before Credit Suisse, we had Deutsche Bank, who also exited prime brokerage. They shed parts of their fixed income business. If we went back to several years prior, there was a lot of the European players getting out of FICC. And, keep in mind, it is a scaled business. And I think where banks like JP Morgan have been winning, and in fact, Goldman Sachs, who has gained the most market share over the last several years, are that they are investing in technology that helps them get better revenue, that helps them have more money to invest. And so it's really that virtuous cycle that some of those big U.S. banks have been enjoying.
Thanks to Alison Williams, Bloomberg Intelligence Senior Analyst for Global Banks.
Coming up, we're going to break down earnings from Caterpillar, one of the world's largest manufacturers of heavy machinery.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies in 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's turn now to Tesla. So Tesla staff are said to be bracing for potential job cuts. Now, we're told managers were asked whether each of their employees' positions is critical.
We were joined this week by Steve Mann, Bloomberg Intelligence Global Autos and Industry Research Analyst. We first asked for his take on the potential job cuts.
Job cuts are never good for the employees, but I think the investors will probably look at it positively because the stock's been down like 12% since their last earnings call and 30% year to date. And that's all because, slowing EV sales, price cuts. So the company needs to do something to address some of the short-term challenges they're facing.
So when I see news like this, it really makes me think, Steve, that maybe they see something fundamental in their business such that they have to look at a big fixed cost like people. What's the company saying these days about where they see, demand?
Well, that's a good question. I think you got two questions there. First of all, fundamentally, they've done a lot of price cutting, in their operations, in the administrative side of things, in their manufacturing. They plucked out all the low-hanging fruits. There's not much to cut anymore other than looking at their human resources, and that's what they're doing at this time. Now, obviously, you don't want to cut, but I think they have to. If you look at Ford's earnings call, the market is really brutal. Mm-hmm. The margins was down was at negative 98% for Ford's EV business. That's worse than their third quarter. So from that, you can see the whole entire EV market is still facing, price cuts, slower demand. And that's, I think that's what Tesla is trying to address for 2024.
Hey,
with
Steve,
these,
do we have an idea of when the trough might happen for EVs? Is it just going to take cheaper ones, or is it going to be actually more hybrid and that trough be really pushed out?
I think hybrid is a good kind of fill-in between now and when, EVs can take off. Our view is actually, around 2026, because I think that's when cost of manufacturing EVs will come down with localization of battery production, more EV models out there, and every automaker right now is talking about the second generation of EV vehicles, the third generation of EV vehicles. They're actually designed on a very different platform than the ICE vehicles, the internal combustion engine vehicles, that is supposed to streamline production, cut the number of parts, and hopefully drive costs down to make it more affordable for the consumers.
So it's a 26 story. Will the charging infrastructure also be a 26 story?
Well, no, there are some spending at the moment to increase charging infrastructure. I mean, that's another bottleneck that the industry is facing. I think, out in the West Coast, out in the East Coast, charging infrastructure are not of a big concern, but Central America is. So that's where the focus is, I think, in the next couple of years to really build up the charging infrastructure in that part of the country.
How many charging units do you have at the Princeton campus at Bloomberg right now?
Oh, it's interesting. If you go out to the parking lot here, you think it's a Tesla dealership out here. There's probably 50,
Wow.
40 to 50
Do people
charging
have
stations.
the cars? Like, are the Teslas actually being plugged in, or EVs?
Oh yeah. You'll see mostly Tesla. You'll see a couple of Volkswagen, a couple of Volvos, but
Because when
I was at
the Princeton campus, Steve, I guess I haven't been there since before the pandemic. Let's call it 5 years. 5 years ago, we had 2. Now you're telling me we have 50. That is a good barometer, I think. Now, I think Bloomberg is usually on the cutting edge of this stuff, but still interesting.
Yeah, and I wonder, did you get the idea that the charging was there, therefore you brought the EVs? Or it's just a clientele that has the EVs? Unfair question, but what do you think?
That's a good question. It's all about the cost of ownership. You're right, Alex. Having the charging stations here, make it convenient for people to charge and really cut their monthly costs, right? There's no fuel costs anymore with the EVs.
Our thanks to Steve Mann, Bloomberg Intelligence Global Auto Analyst.
Now we look at Caterpillar, one of my faves, one of the world's largest manufacturers of heavy machinery. Then earlier in the week, the company reported higher fourth quarter sales in its energy and transportation business.
For more, we spoke with Chris Ciolino, Bloomberg Intelligence Senior U.S. Machinery Analyst. We first asked Chris for his key takeaways from the earnings results.
It was a real solid print, despite the fact that we continue to see these really cautionary signs out there of slowing demand. The 4Q results, broadly exceeded not only our expectations, but I think CAT's internal expectations as well. Pricing continues to surprise to the upside. The margin performance was quite good, particularly in their energy and transportation business. Retail sales to end users continued to hold up reasonably well. Orders came in better than we anticipated, and the cash generation of the business, remains very strong. So there's a lot of positives to take away from the report, and I think this probably dispels some of those, concerns over a more pronounced or near-term cyclical downturn, at least for the time being, as it appears, 2024 is really shaping up to be a little bit maybe more resilient than we had anticipated going into the print. That being said, we still think there remains risk, and it's mostly to the downside moving forward here. And we're really kind of cautious on the sustainability of this performance, especially as the macro backdrop begins to soften.
So what's the company saying about their outlook? And I guess my question, A, what's the company saying? And B, what's their lead time on, how far out can they see in terms of their orders and things like that?
Yeah, so they're looking at 2024 as kind of being more of a flattish type top line environment. Caterpillar's notorious for not giving much on the guidance, but they're kind of suggesting that top line will be relatively flattish. Volumes will be down next year, so this is going to be more of a pricing story, and particularly in the first half of the year as we get some of those carryover pricing benefits. So, and I suspect margins will come under some pressure, and we could see some modest contraction on the earnings line as well. In terms of the backlog and the visibility, it's above average. The backlog continues to be, remarkably strong. You have roughly $27.5 billion in the backlog. I think one of the surprises of this report to us was orders. Implied orders only came down about 4%. So we saw the decline in the order rate moderate. So I think that's another positive sign that, we're not looking at this type of draconian type scenario for 2024.
So explain this one to me. What about the China factor? Because Air Products, their chemicals business in China did terribly, and that's why the stock is down so much. I appreciate they're different industries, but still, CAT is very levered to China also. What did we learn about that?
Nothing incremental, right? So Caterpillar, China for Caterpillars, historically it's been kind of in that 5 to 10% of revenues. 2023, this past year, we were below 5%. They're telling us that they don't anticipate much change in 2024. But if you're a cat bull, I think that's one of the catalysts that you could potentially look at, is that if or when we do get this China recovery, that would certainly bode well for cat.
Hey, Chris, I know investors in these types of stocks, these industrial stocks, they're used to cycles, and they're probably saying, but God, we have to have a down cycle coming up here. But there's a lot of infrastructure work out there, stimulus coming out of the U.S. government, out of the pandemic. Isn't this going to make this cycle different? Like it's going to be longer up for these companies?
Yeah, I mean, we hear that this cycle is different almost all the time, right? I'm a little bit more in the skeptic camp. Listen, North America was tremendous this past quarter and this year. I think it was the only region with positive growth on the top line. We saw 11% growth here in North America. A lot of that is largely driven by non-residential and infrastructure-related spending. So it's certainly been a tailwind, and I do suspect that still has some longevity to it here over the next few years. But there's a number of cyclical factors, to your point, at play here. And historically, this stock, when the backlog starts to come down, when orders inflect, that's not an encouraging sign for future performance.
But we also have lots of stuff like the IRA, we have the semiconductor bill, we have the Industrial Act sort of reshoring, all that stuff. We have learned from industrials that getting benefits from those pieces of legislation takes a lot longer than the market was expecting. Like just in the CHIPS Act, maybe we're seeing some stuff happening, and even that's getting pushed out, like we saw with Intel. What is Caterpillar saying about that visibility?
Yeah, so I think longer term, there is certainly an opportunity, particularly what they've kind of deemed this energy transition to, alternative fuels or electrification. There is going to be demand for mined commodities, and they anticipate that this shift will increase their addressable market. So no doubt, we do think there is a longer term opportunity here. We think it's probably still many years out before we start seeing, more tangible financial impact from some of these. Infrastructure bill is the more near term impact that we've seen and the results this far. So we think that's probably still a little bit longer down the road and somewhat difficult to quantify at this juncture.
So, Chris, you follow all these big industrial companies in addition to CAT. I mean, Oshkosh, Cummins, Volvo, Packard. What are those big companies that are so skewed and so exposed to kind of the industrial side of the economy? What are they kind of telling you these days?
Yeah, so if you think about all the machinery verticals, we were essentially at peak cycle in 2023. Almost all those markets, we expect volumes to be down in 24, some holding up better than others. But I think one of the things that we continue to hear is that this downturn looks a little bit more modest and short-lived than what we have seen historically. I might say the one caveat to that being on the ag side, as we continue to see crop prices and farmer incomes under pressure. But at least at this point, we see on the commercial vehicle side being a little bit more modest. And even on construction equipment, there's a number of offsets to the more traditional cyclical headwinds. So again, not looking at this as some kind of a steep or severe downturn. It just seems to be much more modest than what we've become accustomed to.
Our thanks to Chris Ciolino, Bloomberg Intelligence Senior U.S. Machinery Analyst.
All right, coming up on the program, we're going to discuss why war in the Middle East is hurting McDonald's sales.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We turn now to the fast food industry. McDonald's sales missed investor expectations in the fourth quarter as growth decelerated.
To help recap, we were joined by Michael Halen, Bloomberg Intelligence Senior Restaurant and Foodservice Analyst. We first asked Michael for his big takeaway from McDonald's earnings results.
Yeah, it was a weaker quarter than most expected, for sure. Sales growth was kind of weak. You know, they cited the impact from the Israel-Hamas war, and obviously that hurt results in the Middle East, but also in Muslim countries like Malaysia, and also countries like France that have a large Muslim population. It may have impacted sales here in the U.S. a bit as well. There were some calls to boycott the brand right after the start of the Israel-Hamas war. Those kind of went away in December and January, however. So there could have been a mild impact in the United States as well. And then in terms of key takeaways from the call, you know, they don't expect their developmental markets where the Middle East is located to improve really until the war ends. And they cited some consumer weakness in the United States, which they have before, right? But it seems like it may be spreading in terms of, you know, just low income consumer weakness. You know, it sounds like their customers right now are managing their guest checks.
Hey, Mike, I'm just looking at the PGEO function on the Bloomberg Terminal, and I see that roughly 60% of the revenue comes from franchise-operated stores and about 40% from company-operated stores. How did they make that decision about when they go to a particular location, whether to franchise or own it?
I think a big part of it is return on investment, right? So if the returns on the investment are very strong, they typically want to hold on to those stores or develop stores. You know, they'll do some store development in the United States and in their more established markets, but it's going to be a small percentage of what they're doing going forward. You know, most of their growth is going to be, you know, done by their strong franchise partners, particularly in China and some of these other very fast-growing markets.
Talk about the input part of the situation in terms of their costs, in terms of their labor and all that kind of good stuff.
Inflation is easing for them this year, but it's still probably higher than normal.
Cows.
They're looking at
it's cows, man.
Yep.
Cows.
That's part of it. For sure, beef and dairy costs are expected to be higher this year. So, but they're looking at low single-digit commodity inflation in the United States and abroad. Abroad had, Europe had very high inflation last year, and that's going to settle down a bit. Labor inflation is going to continue to be higher, and a big part of that here is, in the U.S. They're California, April 1st puts in the $20 minimum wage for fast food workers. And so that's going to impact some of their stores, primarily their franchisees, however. So they're still seeing, higher inflation than, we had in the 20 teens for sure.
Hey, Mike, I look at this stock and, I need to pay a 22, 23 times earnings for this stock. What am I really getting? Is it something more than GDP top line growth? What's really the call behind this kind of stock?
Yeah, well, with their global growth, they're going to probably grow quicker than GDP. What you're buying with a franchise business is, pretty stable and predictable earnings growth, free cash flow growth. There's not a lot of operating leverage in the model, and so they're asset light, and so they can lever the business up and return cash to shareholders pretty aggressively. So it's definitely an attractive model, especially one with the strong top line growth like McDonald's has, and they're also. Most investors consider them slightly insulated against a recession and slower economic times, and a big part of that is the value that they offer. Mm-hmm. During the Great Recession, they outperformed the quick service industry pretty significantly, acquired a lot of market share during that time, and so investors feel some safety investing in McDonald's versus some of the other restaurant chains out there.
But Mike, that confuses me with what you said about customers watching their checks and their items and what they're buying. Because you would think if things are hard and people are struggling that you would get more value and people would go to McDonald's. But you were mentioning how, in general, people are watching their money more, so they're not. How does that kind of square?
Yeah, so what we've seen is a lot of traffic deterioration over the last couple of years because price increases have been so aggressive and people's spending is being pinched, right? But the thing about quick service, they're in the lower end of the market, right? And so they'll see during an economic slowdown, they'll see higher and middle income consumers kind of fall into their bucket. They'll spend less at higher cost, full service occasions, and they'll visit McDonald's more often, whereas a lot of the low income consumers will kind of fall out of that bucket and decide to opt for the grocery store more often. So they'll lose some traffic on the low end, but they'll probably gain some with some of the middle and upper income consumers.
So Mike, who's really their competition these days? When I was a kid, it was Burger King and Wendy's, but now there's so much more out there. How do you kind of slice it?
Yeah, it's the restaurant business, man. It's so fragmented. There's competition everywhere, man. To your point, convenience stores, grocery stores, food trucks, you name it. Still, primarily, their biggest competition are the fast food restaurants that are located closest to them. So it depends on the market. California, Jack in the Box is number 2. On the East Coast, Burger King is number 2 in most markets, I'd say, in the United States. Wendy's obviously is a big competitor of theirs, but also, places like Chipotle and Shake Shack are all competing for restaurant dollars with McDonald's. But, we don't look too closely at market share in this business because it is so fragmented. And I don't really like total addressable market in restaurants because nobody's going to eat at McDonald's 3 times a day, 7 days a week.
Thanks to Michael Halen, Bloomberg Intelligence Senior Restaurant and Food Service Analyst.
All right, let's go next to the luxury industry. Earlier in the week, Estee Lauder said it's cutting as many as 3,000 job positions as part of a broad restructuring plan. Now, the plan is aimed at making the cosmetic giant a more profitable company.
And this comes as plummeting sales in Asia have dragged down revenue and profit at Estee Lauder in the past year. For more on all of this, we're joined by Deborah Aitken, Bloomberg Intelligence Senior Analyst. She covers global luxury goods, home, beauty, and personal care. I first asked her for context of the restructuring plan already in play.
They've raised 500 to 700 million of cost on a deeper restructure program to bring up to 1.4 billion through 25 and 26, mostly 25 or majority 25 weighted, with the expectation. So that's kind of like 400 million extra on what they were expecting before.
Deb,
in terms of operating profitability.
What was the problem that they had to fix by doing that? Like, why is it so hard to be Estee Lauder? I thought everyone would pay $1 million for perfect skin, not talking my book or anything.
Right, the big thing over the last couple of years that we've always known that Estee Lauder a very premium product, and it did so well for so many years, but it had very high exposure in Asia. So we ended up a couple of years ago with a stuffed retail, duty-free travel retail area across China and some parts of Asia, which were exacerbated by South Korea also in the issues there with the Daegu shopper. And what we found, and we'd always been saying, their supply side, the way that they organize themselves, the logistics, they didn't have the hubs in place in Asia to do as much as they were doing. So they were caught short or caught overstuffed. So they had far too much in trade, and that has taken a long time to temper down and start to normalize, and we should return overall to growth this next quarter.
And Deb, let's stay with the China story, because I know from talking to you over the years and reading your research, the China consumer is just critical for luxury shopping. Can you give us a sense? Because when I walk down Madison Avenue or Fifth Avenue, I see all the European tourists back. They're back in size. Not so much with the Chinese. What's going on there?
The big thing, very late in getting visas through, the reopening of, as we thought from the beginning of last year, reopening of travel, but the view is that travel internationally won't come back until the second half of the year. And we are starting to hear some of those luxury companies saying we're seeing more Chinese, more Asian customers in our stores. Back home, there's a lot more spending, flights are fuller. The surveys that we're doing are saying that they will travel, but a lot of that travel so far has been across Asia.
But what's interesting is that not all are created equal. I feel like you can cherry pick a couple of luxury stocks that have been somewhat immune. And I'm just wondering what those are. And I still like, and in the skincare world too, like what is that immune skincare high-end product that doesn't matter? We're all buying it anyway.
I think that, there's some huge numbers in terms of some of the brands within the Estee Lauder portfolio doing extremely well. Lots of the brands up double digit, but it's that trade that draws down. When you look at the Europe number for Estee Lauder, that's where they stock travel retail. That's where it sits in its P&L, and it's down minus 14. But actually, Europe underlying is flat, and it's the same for the North American market. Within that, there are brands like The Ordinary and La Mer, and several of the higher end brands doing very, very well, up double digit. And it's the same across. If I think about the way that actually luxury, and L'Oreal aside, L'Oreal is doing phenomenally well with a high base of its product in what it classes as L'Oreal Luxe. But let's go to some of the luxury companies and the way that LVMH and others are building sizable scale in perfume and cosmetics. That's for growth of 6 to 8% per year and very strong margin. So there are a lot of brands out there doing very, very well. But in particular, what has happened is, and stock pick and cherry picking, it's about the brands who've had the portfolio that hasn't had so much Asia travel retail, or where it's really been able to manage that. Because even if I think about LVMH, within its selective retailing, it housed DFS, duty-free stores, and Sephora. And at one point last year, they were both down, and they've now fully recovered. We're starting to see for the US some robust numbers coming through, even from that aspirational end, across luxury, across brands. It's getting a little better, but it's going to take time.
How are the luxury stock? What's kind of the luxury call here? I look at the FA function for Estee Lauder, and it looks like for the fiscal 2025, the June of 25 year, the street's looking for a big pickup in revenue and profitability for Estee Lauder. What's behind that?
That's all about that inventory. And to put that inventory in Asia into context, it's dragged down skincare in this quarter, organic sales minus 10%. It's dragged down Europe to minus 14, where underlying Europe was flat because it stores that travel retail. So it's about that inventory normalizing, and they're saying that has happened right now at the end of 2Q. So we head into 3Q with normalized level. And so therefore, if that is the case and it's better managed, we should start to see double-digit growth coming from there. And if we were looking underlying without that area, then we saw mid-single digit growth. So that's what that's about. And then also on top of this new restructuring program, and with some of those benefits to come through 25, we've been playing around on MODL on the calculator. And what we see there is around an expectation of 12 to 13% uplift to that 2025 operating profit to hopefully come through on consensus.
Our thanks to Deborah Aitken, Bloomberg Intelligence Senior Analyst, Global Luxury Goods, Home, Beauty, and Personal Care.
That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
And remember, you can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney. Stay with us. Today's top stories and global business headlines are coming up right now.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.